All right, let's get right into it. Picture this. It's the dot-com crash. Total chaos, right? And in the middle of all that rubble, one of the greatest financial detective stories of our time starts to unfold. It involves Warren Buffett in a company that, honestly, everyone thought was toast, Amazon.com. But here's the thing. This wasn't some wild bet on the future of online shopping. Nope. It was a cold, calculated play based on a single clue that was hiding in plain sight.
So this was the verdict from Wall Street back in 2001. I mean, it was basically a death sentence, and it was handed down by one of the most influential analysts on the street, Ravi Surya over at Lehman Brothers. And just that one statement, that one powerful call, it set the stage for what would become one of the most legendary contrarian trades, well, ever.
Okay, to really get how brilliant this trade was, we have to travel back in time. We've got to go back to the scene of the crime, if you will, the absolute carnage of the dot-com collapse. And Amazon, well, it wasn't just another company caught in the crossfire. It was basically public enemy number one.
I mean, the numbers here are just staggering. The Nasdaq had lost 80% of its value from the peak. 80%. And in that kind of environment, just pure panic, the market wasn't making any distinctions. You had total frauds and legit businesses, unprofitable but legit, all getting lumped together. And Amazon, its stock had just collapsed from over $100 a share down to single digits. It was completely thrown out with the trash.
And this fear, it wasn't just pure emotion. It was backed up by some serious analysis. It had this sharp intellectual edge, all thanks to Lehman's Ravi Surya. He's the one who built the data-driven case that basically convinced the entire world to bet against Amazon, to short it into oblivion.
So, Surya's whole argument, it was simple and honestly terrifyingly logical. He said, look, Amazon's working capital is getting worse and worse. He predicted its suppliers, the book publishers and distributors, they were going to panic. And when they panicked, they'd stop giving Amazon credit and demand cash on delivery. And that would trigger a death spiral, a liquidity crisis that would just drain Amazon's bank accounts completely dry. Game over, right?
But, and this is where it gets good, two financial detectives, Warren Buffett and his amazing colleague over at Geico, Lou Simpson, they looked at the exact same data, the same numbers everyone else was looking at, and they saw something completely different, something the rest of Wall Street had totally missed. So, where was this hidden clue? Well, it was buried in a seemingly boring accounting concept. It's called the cash conversion cycle. Now, I know, it sounds super complicated, but it's really just about how money flows in and out of a company. And for Amazon, the way it worked was, well, it was completely revolutionary. It basically broke all the old rules of retail.
And this slide just lays it out perfectly. Look at a traditional retailer on the left. They have to pay their supplier first, then they get the inventory, then they sell it to you, and finally they collect the cash, right? But Amazon over on the right, they just flipped that entire model on its head. They sold you the book, collected your cash instantly with your credit card, and only then, sometimes weeks or even a month later, did they have to pay their supplier. See the difference?
So here's the absolute knockout punch. That one metric that all the bears were pointing to as a sign of death, that negative working capital, it wasn't a bug, it was a feature. It was actually a source of cash. It was what Buffett calls a float. Think of it like a giant interest-free loan from its suppliers, and Amazon was using that loan to fund its own explosive growth. The bigger Amazon got, the more free cash it had to play with. Incredible!
So, armed with this incredible insight, what did Berkshire Hathaway do? They didn't just rush in and buy the stock. No way! That was still way too risky. Instead, they did something much smarter. They executed this precise two-part surgical strike by buying Amazon's debt.
Now, they targeted two totally different kinds of Amazon debt. As you can see here, Lou Simpson over at Geico, he took the safer path. He bought what are called senior notes, which just means if things go south, he's first in line to get paid back. Buffett, on the other hand, he went for something a little riskier, a subordinated bond. It was trading at a massive discount, but Buffett saw something amazing in it, a hidden triple play.
Okay, so let's break down this triple play. Part one was just the price. He was buying these bonds for 57 cents on the dollar. That's a huge discount. It meant Berkshire would make a 75% profit if Amazon just survived. That's it. Just pay the debt back and boom, 75% gain. Part two was the yield. Now, the bond had a coupon of about 6.875%. But because Buffett bought it so cheap, his actual effective cash yield was over 12% a year. Think about that. He was getting paid a massive 12% a year just to sit back and wait for everyone else to figure out they were wrong about Amazon. But the third part, oh man, this was the real masterstroke. This was the hidden gem. See, these bonds weren't priced in US dollars, they were priced in euros. And at the time, Buffett believed the euro was super undervalued compared to the dollar. So he wasn't just betting on Amazon's survival, he was also making a massive, hidden bet against the US dollar. It was a trade inside a trade. Absolutely brilliant.
So how did it all play out? Well, as we all know now, Amazon did not go bankrupt. Shocker, right? By early 2002, the company actually posted its first ever quarterly profit. It stabilized, and then it called its debts back early, which handed Berkshire a huge win. But when they tallied up the final numbers, there was a really fascinating surprise in there. So their initial investment was about $169 million. And that turned into a staggering profit of $246 million. I mean, what a fantastic return. But the really interesting question, the one we need to ask is, where did all that profit actually come from?
And here is the big reveal. This is the twist. When you break down that profit, check out this chart. Only a little over half of it, the 52% slice, came from Amazon actually recovering. The other chunk, nearly 48% of the entire profit, had almost nothing to do with Amazon at all. It came directly from Buffett's other bet, his wager that the euro would get stronger against the dollar. So you see, this wasn't just a simple corporate bond trade. It was a global currency trade cleverly disguised as one.
So, after walking through this incredible story, what can we actually learn? What are the big takeaways from this absolute masterclass in contrarian investing? Okay, let's open up the detective's notebook. Lesson 1. You have to read the balance sheet, not just the scary headlines. Real financial insight isn't just about the numbers themselves, it's about understanding their nature. It's about seeing how something that looks like a liability can actually be a huge asset. And lesson 2, you don't always have to swing for the fences and take on equity-level risk. By choosing to be a lender here, Berkshire got stock market-like returns without the same level of risk. It was really the best of both worlds.
And all of this leaves us with one final big question to think about. In today's market, with all of its own crazy stories of doom and hype, where is the next Amazon bomb hiding? Where is that next great trade? It's probably not in some super popular growth story. It's much more likely to be hiding in the misunderstood balance sheet of a company that everyone, and I mean everyone, has already given up on for dead.